Hello, good afternoon to you all. I welcome you to my revision session. This is Senior Hannington, your financial reporting tutor. Now, in this session, of course, we are looking at group accounts at level 3. We know that at level 2 in your financial reporting, you covered the basic groups. However, when it comes to level 3, emphasis is on more complex aspects of consolidation. You are unlikely to be examined just on the basic principles, but of course you gain marks for knowing the basic principles in a more complex consolidation at level 3. Of course, one of the competencies you need is to record and understand financial transactions for single companies and combined ones and combined entities. Of course, in this video, I'll use the CPA Advanced Financial Reporting, that is March 2022. Then we see how we can revise through group accounts, and then how we can deal with those complex matters when it comes to consolidation at level 1 and level 3. Remember, this is an area which you have to concentrate on and give it time, because we know that at this level, the compulsory question carries 50 marks, still even in the new syllabus. Your question 1 will carry 50 marks, and of course, it's a compulsory question. And of course, question 1, we know that from the past, it has been from this area of group 1, from this area of group accounts. You will be given financial statements for different companies depending, and you will be required either to come up with a consolidated statement of financial position, either to come up with a consolidated statement of profit or loss and other comprehensive income, or it can be about a statement of cash flows for the group. So here, of course, we look at this question 1 of March 2022, we see that it's likely to be a statement of financial position, because we have given you the draft statement of financial position for the different 3 companies, as we can see. They are telling you that GL is a limited company. GL is a limited company that has shareholdings in other 2 companies, ML as well as NUL. Gwangweno Limited prepares financial statements to 30th June each year. So every 30th June, they prepare their financial statements. And of course, we see that the following draft statements of financial position as at 30th June 2019 for the 3 companies are given below. So you have BL, ML, as well as NU, as well as NUL. So you have the assets of each of these 3 companies. Then you also have the non-current liabilities, current liabilities, as well as the equity of each company. We have some additional information as well, whereby we have note 1 that on 1st July 2017, the parent company, which is DL, acquired 14% of the equity interest of NUL for cash consideration of 130 million. And on 1st July 2018, ML acquired 70% of the equity interest of NUL for cash consideration of 635 million. Now, one thing you need to know is that an acquisition of 14%, at an acquisition of 14%, the parent company has no control with this 14%. Of course, here there is no control, and still you may find that the parent company has no significant influence. So an investment with a shareholding of 14% is likely not to be a subsidiary, and also it's not an associate. So this is likely to be an investment in a financial instrument, or we can refer to this as a financial asset, of course. No significant influence, no control. So we can look at this 14% shareholding as a financial asset, an investment in a financial asset. So the parent paid 130 million on 1st July 2017, but after some time, we see that ML is acquiring 70% of the equity interest of NUL for a cash consideration of 635 million. But now you see that ML is acquiring 70% after 1 year. So meaning that the holding in NUL, then a year after, ML also acquired 70%. Now, when you look at this so far, ML is the parent because it has 70%. GL is just having a shareholding of 14% in NUL. So NUL is not a subsidiary and it's not an associate as at 1st July 2017 of GL. However, on 1st July 2018, we see ML acquiring 70% of the interest of NUL. So NUL becomes a subsidiary of ML on 1st July 2018. On 1st July 2017, the identifiable net assets of NUL had a fair value of that, retained earnings of 95, and other components of equity 26 million. That is on 1st July 2017. Remember, GL acquired the 14% of the equity interest on 1st July 2017. And they are giving you the fair value of the net assets as at that date. Of course, those fair values of the net assets as at that date, you will find that you cannot even use them to calculate goodwill, because you can only calculate goodwill if the parent company has acquired more than 50%. So on 1st July 2017, we cannot calculate goodwill because it is an investment in a financial instrument, so no goodwill should be computed. However, on 1st July 2018, we see that now ML has control over NUL. So in such a case, you can calculate your goodwill on 1st July 2018. But remember still, ML is not yet a subsidiary of GL so far, because we don't see its acquisition by GL. Of course, the excess in fair value was due to non-depreciable land. The fair value of the 14% holding of GL, which was classified as fair value through profit or loss, was shillings 140 million and shillings 1 and 30th June 2019, respectively. So they are giving you the fair value of the 14% holding of GL in NUL on 30th June 2018 and 30th June 2019, respectively. Though they are also giving you a fair value adjustment, which you have to make, that there is an excess fair value, which was due to non-depreciable piece of land. So you try to find out that on 1st July 2018, when NUL was acquired by ML. So we have to find out what is the fair value adjustment, how much is that excess in fair value for that non-depreciable piece of land. When we continue, when we go on, they are telling us that, however, the fair value of ML's interest in NUL had not changed since acquisition. So the fair value of ML's interest in NUL has not changed since the acquisition date. Then from there, of course, when you look at note 2, they are telling you that on 1st July 2018, GL acquired 60% of the equity interest of ML. On 1st July 2018, GL acquired. So now you see the parent company is also acquiring shares in ML, 60% of the equity interest of ML. So it is on 1st July 2018. This is the date on which ML also now becomes a subsidiary of GL. But remember, ML already has a subsidiary, which is NUL. So GL is acquiring ML 1 year after its 14% acquisition in NUL. But of course, on the same date, 1st July 2018, when ML is acquiring NUL, its 70% shareholding, on that very date, ML was also acquired by GL. Now, on 1st July 2018, ML becomes a subsidiary of GL. But remember, GL acquires ML when ML already has NUL as its subsidiary. Now, ML is a subsidiary of GL, then NUL is a subsidiary of GL. The cost of the investment comprised of cash, 625 million. At that date, the fair value of the identifiable net assets acquired was shillings 1 million, 11 millions. Retained earnings of ML were shillings 325 M, and other components of equity was shillings 27.5 M. The excess in fair value was due to non-depreciable land. It is the group's policy to measure the NCI interest at acquisition at its proportionate share of the fair value of the company's net assets. Note 3, goodwill of ML and GL was tested for impairment on 30th June 2019. The goodwill of ML was fully impaired by the reporting date. However, there was no impairment relating to NUL. There was no impairment relating to NUL. So the goodwill of ML was fully impaired by the reporting date. However, when it comes to the goodwill of NUL, there was no any impairment loss. So I'm going to use the first 3 notes, note 1, note 2, and note 3, to see how we can calculate our goodwill, as well as also coming up with our group what? Also coming up with our group structure. So I'll start with the group structure. Then from the group structure, we can calculate our goodwill, and then we move on to the other notes, and then we see how we can prepare our consolidated statement of financial position for the group. So I believe you all have the question. So look at the question, note 1, note 2, note 3. I'm going to use those 2 notes to come up with our group structure, the first 2 notes. Then we are also going to see how we can come up with our goodwill as well. So note 1 and note 2, I'm going to use them to come up with my goodwill. So we have workings. This is my workings page. So workings, working 1, we want to say the group structure. Our working 1 is for the group what? Our working 1 is for the group structure. So let us see how we can come up with our group structure. Remember, we have GL as the parent. So GL is the parent company, but this GL acquires ML, then ML also acquires NUL. However, we see that it's the parent that first acquires an equity interest in NUL, and that was made on 1st July 2017. The cost that was paid was 130 millions. And of course, the parent company is acquiring a 14%. Then on that very date, according to note 1, we see that ML on 1st July 2018, it acquires 70% of the equity interest in NUL. The cash that was paid was shilling 635 millions. On the same date, 1st July 2018, the parent company acquires 60% in ML, where the cash consideration was 625 millions. Try to follow the question and see where I'm getting these figures from. So this is a subsidiary because the parent acquires 60% in ML. Then when you look at NUL, this is what we call a subsidiary. It's a subsidiary of the group. One thing you need to know is that in ML, we have a 40% NCI, direct NCI. Direct NCI, because the parent company is acquiring 60% in ML, so there is a direct NCI of 40%. When you look at NUL, the parent has acquired 70%, ML has acquired 70%, but the parent acquired 14%. So when you look at NUL, it is now a subsidiary of the group, though it is a subsidiary. It's a subsidiary. The group so far has ML has acquired 70%, the parent acquired 14%. So we have to calculate what we call the effective interest. Effective interest in NUL. Effective interest in NUL. Of course, the GL group has 60% times 70%, because the parent acquired 60% of ML, and ML is acquiring 14%. ML is acquiring 70% in NUL. So GL group has a share of 60% times 70%, then plus its direct shareholding of 14%. When you do the computations, this gives you 56%. Meaning that your NCI is 44%. Your NCI is 44%, giving us 100%. So that is our group structure. That is our group. That is our group structure in this case. Now, from this group structure, we are going to see how we can calculate the retained earnings. Sorry, how we can calculate our goodwill. How we can calculate our goodwill for the group so far. So in my second working, we are going to calculate goodwill. So this is working 2. We want to calculate goodwill. Working 2, we want to calculate goodwill. Now, when it comes to goodwill, we see GL acquires ML, the parent acquires the subsidiary. So I'll have to calculate the goodwill of GL in ML. Then I'll also calculate the goodwill of GL and ML. So we have 2 goodwill figures because we have 2 subsidiaries, don't forget. So shillings, millions, shillings, millions. However, when you look at NUL, initially NUL was not a subsidiary of the parent company. NUL was not a subsidiary of the parent company because the parent company first acquired 14%, but later on, NUL became a subsidiary of the parent company when ML acquired NUL, and on that very date, ML acquired NUL, meaning that we see the parent company obtaining control in what we call a step acquisition. Because initially it was a 14%, but thereafter it obtained control in NUL through ML. So there is that element of step acquisition, a business combination that has been achieved in stages. A business combination achieved in what? Achieved in stages. You need to know how to deal with business combinations achieved in stages. Okay, calculating goodwill. When it comes to calculating goodwill, we get our consideration transferred. So we start by getting the consideration transferred. Of course, we have what we call direct purchase considerations. From the question, GL paid 625 million to acquire shares in ML. Then it also paid 130 million to acquire shares in NUL, but that was before ML acquired NUL. So that figure, we don't consider it when we are calculating goodwill. We don't consider that 130 which was paid by the parent company, because it was paid before ML had acquired NUL. So we don't need to use that figure when it comes to the calculation of goodwill. Then we have what we call an indirect consideration. Indirect consideration. Remember, NUL is a subsidiary of the group, and the parent company controls NUL through ML, because the truth is the parent company acquired 14%, but because ML is a subsidiary of the parent, NUL will come under the control of the group now. So there will be what we call an indirect consideration. There will be what we call an indirect what? There will be what we call an indirect consideration. We see that ML pays 635 million, but remember, the group has a 60% shareholding in ML. So the group indirectly transfers 60% of the 635 million. course, that will give you 381 millions. That gives us 381 million, 60% of 635 millions. That gives you 381 millions. Now, due to the fact that we see a step acquisition, because NUL initially was not a subsidiary of GL. Initially, it was a financial asset, but later on, when GL acquired ML, then NUL became a subsidiary of the group, a subsidiary of the group. So according to IFRS 3, where we have a business combination in stages, or where we see control being achieved in stages, the standard IFRS 3 requires you to revalue the previously held interest at its fair value. So we have to come up with the fair value of the previously held interest. Fair value of the previously held interest. The fair value of the previously held 14%. As at which date? As at the date of obtaining control. Because DL obtained control over NUL on 1st July 2018. So the fair value of the previously held interest on 1st July 2018, when the parent company obtained control, that fair value is 140 in NUL. Then of course, don't forget, when you're computing goodwill, you have to also show the fair value of NCI at acquisition. So NCI at acquisition. NCI at acquisition. NCI at acquisition, you need to look at the method which you're using. We are using the proportionate share method. Under the proportionate share method, you simply get the NCI percentage. For example, in ML, the NCI is 40%. Then times the fair value of the identifiable net assets of ML, which was given as shillings. $101 millions. 1,011 millions. Then when it comes to the parent company obtained control, we see that what is given as 595, but the NCI in NUL is 44%. Times 595 millions. So 40% of 1,011 M, this gives us 404.4. Then 4% of 561.8 millions. When we add the aggregate of the two, here we have 1,029.4, and here I have 782.8. 782.8. So that is the aggregate of the fair value of the purchase consideration, previously held interest, and then the NCI at up to this. the fair value of the identity fair value of identifiable net assets acquired. Remember, net assets consist of what we call the share capital, consists of what we call the share premium, if it's given in the question. It consists of what we call the retained earnings. But as we are calculating to call the retained earnings, those are the earnings. Then there can also be what we call other components of equity. Then of course, in this case, adjusted in the fair values over the book values. Fair value adjustments, they say that this is a non-depreciable land. So look at your statement of financial position given. Also look at the additional information. Copy the share capital values. Put them in your working for good ones, for goodwill. Share capital of ML, we see we have 600. 5. For NUL, it is 400. Share premium, 36. These figures are the same figures as are the dates of acquisition. They are likely not to change unless maybe when the subsidiaries have issued shares during the post-acquisition period, then the figures are likely to change. But if there is no any change, then of course, if there is no any issue of shares during the post-acquisition period, then you just copy those figures for share capital and share premium. Those are assumed to be the same values, even at the dates of acquisition. Retained earnings pre, these are given in the additional information on note 1 and note 2. So the pre-earnings of ML, the earnings of ML when it was acquired, this is 325. Then the retained earnings of NUL on 1st July 2018 when control was obtained, that is 100, that is 120. Other components of equity have been given still in the additional information. Other components of equity don't use the figures in the balance sheet. Retained earnings don't use the figures in the balance sheet. Those are the figures as at the reporting date. So for you to get the figures to use when you're computing goodwill, check the additional info, check the additional information. So other components of equity, we have 27.5 for ML. Then NUL, you have 35. Then the fair value adjustments, these are the excessive values. They are not given to you, but of course, you have to compute them. Of course, when you look at the question, they are giving us the total net assets of ML as shillings 1,011. Then that of NUL, the fair value of net assets at the date control is obtained is 595. 595. So the excess that represents the fair value adjustment, and that will be the value of the non-depreciable land. So the excess of the fair value for ML, you get your 1,011 minus your share capital, premium, retained earnings, as well as other components of equity. And here your balancing figure is 17.5. That is the excess. Because when you add all these other figures, they don't give you this. So there is a balancing figure, which is 17.5. And that will be the fair value adjustment in the net assets of ML. Then when it comes to NUL, the excess here, the balancing figure, when you add these net assets, of course, you see that the total fair value is not 595. When you add the 400 plus 20 plus 120 plus 35, you don't get 595. So the excess here is 20. The excess there is what? It's 20. So according to IFRS 3, if you calculate goodwill, you get the aggregate of the purchase consideration plus the fair value of NCI at acquisition, then plus the fair value of the previously held interest, then you minus the fair value of the identifiable net assets, then you come up with your goodwill at acquisition date. So our goodwill at acquisition date, here you get 1,029.4 minus 1,000. You get 1,029.4 minus 1,011. Then you get a goodwill of 18.4. Goodwill of 18.4 at acquisition date in ML. Then for NUL, you get your total, which is 782, the aggregate of the consideration transferred, fair value of the previously held interest, as well as the value of NCI. The aggregate is 782.8. Then you minus the fair value of the net assets of 595 to come up with a goodwill of 187.8. So that is your goodwill at acquisition in ML as well as NUL. However, in note 3, the examiner is talking about the impairment losses. Impairment loss. And according to note 3, they are telling you that the impairment loss in ML, there is an impairment loss on the goodwill of ML. In fact, the goodwill in ML was fully impaired, meaning that the impairment loss is equal to the value of goodwill at the date of acquisition. Then there is no any impairment loss in NUL, no impairment loss. So you come up with your goodwill at reporting date. That is 30th June 2019. Here there is no goodwill, but for NUL, we have a goodwill of 187.8 because there was no impairment of this goodwill. And don't forget, in the statement of financial position for the group, this is an intangible asset. In the group statement of financial position, don't forget, that is an intangible asset in the group statement of financial position. So that is working 2. I've used the notes 1, note 2, and note 3 to come up with a group structure as well as to come up with our goodwill. Let us look at note 3 and then we see if we can use note 3 to come up with our working number 3 as well. So let us look at note 4. Let us go back to the question and then we see what note 4 is all about. Note 4. During the year ended 30th June 2019, GL, which is the parent company, sold goods to NUL, that is the subsidiary, don't forget, sold goods to NUL for shillings how much? They are selling these goods to the subsidiary for shillings 60 million at fair value. Shillings 60 million at fair what? At fair value. Note this, at fair value. GL made a loss. GL made a loss of shillings 15 million on the transaction. GL made a loss of shillings 15 million on the transaction, and none of the goods had been sold. None of the goods has been sold. None of the goods has been sold. None of the goods has been sold to the public, but none of the goods had been sold outside the group. By the year end, none of the group by the year. IFRS 10 consolidated financial statements. IFRS 10 states that intragroup trading must be eliminated from consolidated revenues as well as cost of sales. And of course, in case of any unrealized profits, these should be eliminated by increasing the cost of sales. Don't forget. So this is an intragroup trading. As we can see, the parent company is making a loss of 15 million on this transaction. The goods were sold to the sub NUL, 60 million at fair value. They are making a loss of 15 million. None of the goods had been sold outside the group by the year end. Of course, intragroup tradings where a loss is made, such transactions are not common. The transactions that are common are those where the members are making a profit on the transactions. Maybe a parent sells to the subsidiary and then the parent makes a profit on this transaction. But in this case, we see a loss. This is a transaction. This is a note, which is very, very common. It's a consolidation adjustment, which is common on all the numbers of consolidations. You're likely to find what we call intragroup tradings. So you need to know how to deal with these intragroup tradings. So I'm going to come up with a working that will be working number 3, because already we have working 1 for the group structure. Then we also have working number 2 for the goodwill. So I'm going to use this note to come up with a working, and that will be working number 3. Then we see how we can write about this note. So this will be my working 3. And this is this note is about intragroup sale. If you have a question, maybe you can send your questions under the comment section. Intragroup sale. Of course, one thing we need to know that IFRS 10 states that intragroup trading must be eliminated from consolidated revenues. From consolidated revenues and cost of sales, of course. These figures have to be eliminated from our group financial statements, from consolidated revenues and cost of sales. Cost of sales. Of course, any unrealized profits Any unrealized profit should also be eliminated. Any unrealized profit should also be eliminated by increasing cost of sales. Don't forget. If we increase cost of sales, the profits will reduce by increasing cost of sales. That is for the unrealized profit. Now, what happens in case of a loss? However, if a loss is made, if a loss is made, it must suggest that the value of the goods have fallen. It must suggest that the value of the goods have what? Have fallen, and therefore that the loss is actually realized. The loss is actually realized. When you make a loss on this intragroup trading, that loss should not be eliminated. However much the goods are still in the group inventory, the loss should not be eliminated. That loss is actually realized, because when you sell and you make a loss, it will be an indicator that the value of those goods have fallen, and therefore your inventory must have been impaired. So you don't need to eliminate that unrealized. Yes, you may look at it as an unrealized loss because the inventories have not been sold, but according to IFRS 10, it's like that loss is actually realized. So we say that the loss on sale of the inventory of shillings 15 million in this case is not eliminated. It's not eliminated from the group financial statements. It's not eliminated from the group financial statements because the sale is at fair what? The sale is at fair value. The inventory must have been impaired. Must have been what? Impaired. And therefore, the loss on sale must remain realized. The loss on sale must remain realized. So don't adjust your inventories, don't adjust your retained earnings or your cost of sales that you're eliminating the unrealized loss. No, losses should be actually realized. In other words, it will be an indication that the inventories suffered from an impairment loss. And of course, we have to be prudent enough to recognize this loss. But if it's a profit has to be eliminated. Any unrealized profit must be eliminated. But if it's a loss, the loss has to be recognized. So the loss must remain realized. So you leave it in your group financial statements. Don't do any adjustment on inventory, and you don't do any adjustment on the group retained earnings, that you're eliminating that loss of 15 millions. Of course, if it was a P&L, the revenue and cost of sales of shilling 60 million will be eliminated. But this is a balance sheet, so it's not a P&L. Maybe just for revision purposes. However, the revenue and cost of sales of shilling 60 millions will be eliminated. Will be eliminated. So that is the working for intra-group sale. That is not all of the question. That's what you have to know, that if it's a loss, that loss will be realized. The loss will be realized. Let us move on to the next note. Let us move on to the next note of the question. Then we'll see what happened. Now we move to note 5 of the question. On 1st July 2017, GL acquired a manufacturing unit and an 8-year finance lease. The lease rentals have been recorded correctly in GL's financial statements. However, GL could not operate effectively from the unit until alterations to its structure costing 6.6 million were completed. The manufacturing unit was ready for use on 30th June 2018. The alteration costs were charged to administration expenses. The lease requires GL to restore the unit to its original condition at the end of the lease term. GL estimates that this will cost further shillings 5 million. The market interest rate is currently 6%. 6%. So that is not 5. When you look at note 5, of course, we see leases. So I'll have to apply IFRS 16. However, there is also provisions, because we know that if we make an estimate of the cost that will be incurred to dismantle and restore the site on which the asset is located, then we have to create a provision in accordance with IS 31, in accordance with IS 37, provisions, contingent liabilities and contingent contingent assets. Still, when you go back to IAS 16, property, plant and equipment, when we are computing the cost of an item of PPE, according to IAS 16, still you'll see that the initial estimate of the cost of dismantling and restoring the site on which the asset is located, those costs should be capitalized according to IAS 16. So we have an estimate of how much? We have an estimate of 5 millions rather. We have an estimate of 5 millions. This is the initial estimate of restoring the site, the initial estimate of the cost to restore the site. Of course, this is the future cost which will be incurred at the end of the lease term, but according to IAS 37, we have to discount this and get the present what? And get the present value using the market interest rate of 6%. So we have to create a provision. This cost is to be capitalized. So what we do here, we capitalize. Capitalize the PV. Capitalize the PV of the estimate and recognize a provision. And recognize the provision. That treatment is in accordance with IAS 37 and IAS 16 as well. Now, when it comes to the cost incurred, the cost of alteration of the structure, this is a capital expenditure. This is a capital expenditure. This is a capital expenditure. So capitalize. Capitalize and depreciate. Capitalize and depreciate over the remaining useful life. Over the remaining useful life. Even these costs which you have capitalized for the present value of the estimate, you have to also depreciate them from the date on which that estimate was made. So let us try to make some notes on this. This will be our work number. This will be our work number what? This will be our work number 4. Let us write about this D manufacturing unit, and we see what to do. That's not 4. So under the list manufacturing unit, this will be our work number 4. You can say working 4. This is the manufacturing unit. This is the manufacturing unit. You can write and say that the initial cost of the alterations should be capitalized, of course. Should be capitalized and depreciated. And depreciated over the remaining useful life. Or the useful life of the lease. And not charged as an expense. Of course, we see a wrong treatment that was made by the accountant because these costs were expensed, but they should not be expensed. They should be capitalized. Of course, we can also tell the examiner that in addition to this, IAS 37 provisions. IAS 37 provisions. Contingent what? Contingent assets. And contingent liabilities requires that the cost of restoring the property to its original conditions should be provided for on 30th June 2018. Why? As this is when the obligation to incur the restoration costs arises. So this date is very, very key, as this is when the obligation to incur the restoration costs arises. Full stop. The PV, the present value, the present value of the restoration costs is showing how much? 3.3 millions. 3.3 what? 3.3 millions. Of course, to come up with 3.3 millions, we know that the amount that was The estimate was 5 what? The estimate was 5 millions. The discount rate was given as 6%. So when you check on your tables, yeah, what? Because now the lease, the inception of the lease is 1st July 2017, but the obligation, we should provide for a provision on 30th June 2018, as this is when the obligation to incur the restoration cost arises. So at 6%, year 7, I use year 7, why? Because so far they have used the leased asset, the manufacturing for 1 year, and this obligation arises on 30th June 2018 when you try to look through the question. So meaning that I will use, this is 5%, 6%, 5%. It's the first say, I think it's 6%. So 6%. It's 6%, 5%. Yeah, 6%. Market interest rate is 6%. 6% of year 7, we have 0.665. So I get 5 million times 0.665. When you do that, of course, you get 3.1. When you compute, you get 3.3. 0.665. We get 3.3 millions, so that's what we get. So the present value of the restoration cost is 3.3 millions, and yeah, this should be added. Should be added to the initial cost. The initial cost of the alterations and it depreciated over the remaining life. Over the remaining life of the lease. Over the remaining life of the what? Over the remaining life of the lease. Full stop. Of course, a corresponding provision should also be created. And the finance cost, don't forget on this provision. And the finance cost of 6% per annum should be charged. To profit or what? Profit or loss. And the accrued on this provision. So that is the note. The restoration costs should not be expensed, they should be capital they should be capitalized. Then in addition to that, the estimated cost to be incurred on restoration of the site, that one should also be capitalized. But of course, we capitalize the present value. So we have to discount and get the present value. Discount and get the present value of that estimate. Then what are the adjustments required? Adjustments required. Of course, I will have to debit my PPE with a total of shillings 9.9 M. Why 9.9 M? The 3.3, the PG of the restoration cost, that one should be capitalized, as well as the 6 millions that were wrongly expensed, but they would have been capitalized. So the adjustment made on our PPE is a debit of 9.9. Then we have to go and credit retained earnings. Credit retained earnings with the shillings 6.6 millions. Why? Why 6.6? Of course, when it comes to the retained earnings, we know very well that retained earnings, of course, will increase by 3.3. Why 3.3? So it will increase by 6.6. Why? Because first of all, we have what? We have the wrongly expensed amount. The wrongly expensed what? The wrongly expensed amount of how much? Of 6.6, because they talked about the 6.6. That was wrongly expensed. According to the question, they are telling you that 6.6 was expensed and charged to the administrative expenses, which is not correct. So you have to cancel out that by crediting your retained earnings. Then, of course, at the same time, you have to credit your non-current liabilities. By shillings, how much? By shillings 3.3, the present value of the estimate, the provision of 3.3, that one will be taken to the non-current ones, non-current liabilities, 3.3. But remember, these costs have to be depreciated. So we have a depreciation expense. We have to depreciate these costs over their remaining life, useful life. Depreciation expense will be 9.9 M. Over how many years? Over 7 years, because 7 years, that is the remaining period, since these costs were cut. So this is 1 point, this is 1.4. Where do we take this? Of course, this is to be debited. to be debited to retained earnings because this will be an expense now to be recognized in the current period. To be debited to retained earnings and credited PPE because this will now reduce the value of your property, plant, and equipment. Then, of course, we have to calculate a finance cost for the year on the provision. This will be 6% times our provision, which is 3.3 M, to account for the time value of money. This gives you 0.198 M. Debit, retained earnings, don't forget, and credit, provisions. For this accrued finance cost. For that accrued finance cost. So that is the note of the LISD manufacturing unit. From there, of course, we move to the next note. We move to the next note. I think that is note 6, according to the question. We have note 6. On 1st July 2017, DL acquired an office accommodation. DL acquired an office accommodation at a cost of 45 millions. At a cost of 45 millions with a 30-year estimated useful life. During the year, the property market in the area slumped, and the fair value of the office accommodation fell to 37.5 million as at 30th June 2018, and this was reflected in the financial statements. This was reflected in the financial statements. This was reflected in the financial statements. However, the market unexpectedly quickly recovered due to the announcement of a major government investment in the area's transport infrastructure. On 30th June 2019, a valuer advised DL that the offices would be valued at shillings 52.5 million. DL charged the depreciation for the year, but not consider the upward valuation of the offices. DL uses the revaluation model and records any valuation change when advised to do so. So in this note, of course, we are going to apply IAS 16, that is property, plant, and equipment. You apply IAS 16, property, plant, and equipment. Then, of course, initially we see that there was impairment loss on this asset because its value fell to 37.1. Its value fell to 37.5. So there is an impairment. So we have to apply IAS 36 as well as IAS 16, property, plant, and equipment. Let us calculate the impairment loss and then also calculate the revaluation gain on second time revaluation, and then we'll see how we should treat this in our consolidated financial statements. So this is working number 5. This is PPE, property, plant, and equipment. I'll summarize the working. I'll put shillings millions. Of course, you have to come up with the cost of the asset. Cost as at 1st July 2017. This cost was 45. Then the depreciation for that year, because when we revalue, we have to compare the current amount of the asset with the valued amount. So depreciation for the year is 2018 financial year. The asset has useful life for 30 years. So the current amount of the property as at 30th June 2018, when it was revalued, this will be 43.5. We are depreciating for only a period of 1 year from 1st July 2017 up to 30th June 2018 because it was revalued on 30th June 2018. So we have a current amount of that amount. We have a current amount of 43.5. Now, this very property was fair valued. Its fair value fell. Fair value as at 30th June 2018, its fair value is given as 37.5. So we see an impairment loss in here. We see an impairment loss of around 60 million. We see an impairment of 6 millions. Of course, this was expensed in that period. Expense in the group statement of profit or loss. By then, 2018, that is 2018. However, in the current financial year 2019, the property was revamped, the property was revalued. This same property was revamped, it was revalued. So now in 2019 financial year, we see the fair value as at 1st July 2018, given as this 37.5. And of course, we have to depreciate that year. So depreciation for the year that will be 37.5 M over how many years? Of course, now 29 years remaining because it had its life of 30 years. We used it for 1 year, then it will revalue it. So its useful life will be 29 million. So with 29 years, so we depreciate the revalued amount over the remaining useful life, and this gives us a depreciation of 1.3 million. So we get the carrying amount as at 30th June 2019, and this carrying amount is 36.2. The same asset was revalued on that date. Its fair value now increased. It was revalued upwards. Fair value as at 30th June 2019. The fair value of the property now increased to 52.5. So now you see here we have a gain on revaluation of 16.3. From a carrying amount of 36.2 to a fair value of 52.5, we get a gain on revaluation of 16.3. We get a gain on revaluation of 16.3. Now the question is, how should we incorporate this in the financial statements of the group? How should we incorporate this in the financial statements of the what? Of the group. Let us see how to operate this. Of course, as I've told you, I'm going to apply IAS 16 as well as IAS 36 impairment of impairment assets. One thing you need to know is that under impairment of assets, there can be what we call impairment reversals. So in this case, we have an impairment reversal because we see that we have a revaluation gain on second time revaluation, but previously there was a revaluation, there was an impairment loss before. There was an impairment loss before. So there is what we call a reversal of impairment. However, according to IAS 36, they are telling us that we can only reverse. We can only reverse a value that the assets would have been if we had not impaired it in the first place. If there was no impairment, the carrying amount of this asset would have been 42 million as at 30th June 2019. The carrying amount would have been 42 million. So how do I get the 42M? i.e., I'm getting my shillings 43.5M, of course, minus the depreciation of this year of 2019. Annually, the asset depreciates by 1.5M. So 43.5 minus 1.5M, this gives you the carrying amount of 42 million if there was no impairment. So the reversal of the impairment loss to profit or loss. The reversal of the impairment loss to profit or loss is this will be 5.8 million. To get this 5.8 million, we get the historical net book value, historical net book what? Historical net book value. Had there been no impairment? That is shillings 42 millions minus the net book value at date of revaluation. Date of revaluation, which is shillings 36.2 M. That is the 5.8, which is the reversal. Historical NBV, if there was no impairment, and the NBV at the date of at the date of revaluation. At the date of at the date of revaluation. Of course, any excess gain is recorded where? Is recorded in OCI. I is shillings 10.5 M. How do I get the 10.5 M? I'm getting my 16.3 M minus the 5.8 M reversal. The 10.5 will be taken to other comprehensive, income. If you want to show the journal entries, I can show my journal entries. Let me just put them up here. The journal entries, in case you want to show the journal entries. The journal entries will debit property, plant and equipment with the shilling 16.3 millions. Then we shall credit. Our statement of profit or loss. In this case, I'll use retained earnings because we have no profit and loss. This will be 5.8 M. Then I also go to my OCI, other comprehensive income, and we take shillings 10.5 millions. 10.5, we take shillings 10.5, we take shillings 10.5 millions. Take shillings 10.5 millions. So that is the note about property, plant, and equipment. That's our note about property, plant, and equipment, the revaluation, as well as the impairment, loss. What next? Let us check and see what next. So that is our work number 5. When we go back to the question, we move to note 7. On 1st July 2017, NUL acquired, NUL invested financial instruments in a Kenyan company, costing Kenyan shillings 1,760,000. NUL classifies the investment as available for sale. The functional currency of NUL is Uganda shillings. The effects of the exchange differences have never been what? have never been taken into account in the financial statements. Exchange rates were as follows. Exchange rates were as follows. So 1st July 2017, 35.02, 1,760,000. Then 30th June 2018, 38.43, 1,785,000. Then at 30th June 2019, 35.45, 1.8. And then the average for the year is 36. The average for the year is 36.00. This is a financial asset, but of course it's a foreign financial asset for NUL. We just need to translate this at the end of each year. Then any exchange differences arising from the translations will be taken to other comprehensive income. Why? Because this is a non-monetary asset. This is a non-monetary asset, so any exchange difference is taken to OCI, not to profit or loss, but OCI. So this is working number 6. Foreign financial assets. Foreign financial asset. So just show the foreign amount. That is Kenyan shillings millions. Of course, I have my exchange rate, and then the functional amount. Because NUL is functional currency is Ugandan shillings. Of course, we know that on 1st July, when the asset was acquired, its value was 1.76. Remember the figures are in millions, 1.76. The exchange rate here to use is 35.02. When I multiply this by this, we get 61.63. Then on 30th June, its fair value increased to 1.785, but the exchange rate has also moved upwards, giving you a value in Ugandan shillings of 68.60. Then on 30th June 2019, the value increased to 1.8, but the exchange rate dropped 35.45, giving you a value of 63.81. Of course, from 1st July 2017, 30th June 2018, there was an increase in value. So we have exchange differences. There is an exchange gain here. Then from 30th June 2018 to 30th June 2019, we have a loss, or we have a fall in the fair value of this asset. So we have net exchange gain. Anyway, the differences we are coming up with, of course, they include the differences on translation as well as the differences as a result of fair value movements. Because when you look at this financial asset, its fair value kept on increasing. So the differences we have, it's a mixture of the gain and loss on fair value. Of course, it's a gain as a result of fair value movements. When it comes to translation, there is a gain as well as a loss. So this is net exchange gain, net exchange gain, net exchange gain, and fair value movements. Because the exchange differences are there, but you also see the changes in the fair value of the financial assets. So net exchange gain and fair value movements. So initially, we have an increase in fair value of 6.97 M, the difference between these two values. Then minus the decrease, because here it's an increase, but then here it's a decrease. And that decrease is shillings 4.97 M. So the net increase or the net gain is 218 millions. Of course, to generalize this, we debit our financial assets by shillings 2.18 M. Then I'll credit other components of equity. Of course, it should be other comprehensive income, but because you don't have a statement of profit or loss and other comprehensive income, I'll credit other components of what? Other components of equity. This should be taken to OCI. But in this case, we are going to take it to other components of equity. Shillings 2.18 million. Any other note we have? The other note is about recently appointed new members to the finance committee of the board of directors to offer guidance to management on matters pertaining to financial financial accounting and reporting in order to achieve the group what? In order to achieve the group objectives. This is theory. It's all about financial regulation, financial reporting regulation framework in Uganda. I think that is the last part. Let us first ignore this. So the notes are over. Though there are some other workings which you're going to come up with before you come up with your consolidated statement of financial position. I'm taking these differences to OCI. First of all, when you go back to IFRS 9 financial instruments, those financial assets that are classified as investments are available for sale. Their changes in fair value is taken to OCI, and still this is a non-monetary asset, and according to IAS 21, exchange differences arising from translation of non-monetary items should be taken to other comprehensive income, non-profit or loss. So the other working you're going to come up with is the other components of equity working. You will need this. So this will be your working number 7. other components of equity. So here I will have to show those of the parent, ML, and NUL. NUL. Of course, you start with what you have in the question. So you say by the question, so look at your balance sheet for each company. DL, we have 62.5. ML is 40. This is 47.5. There was a revaluation of property. DL did not account for the upward revaluation. Don't forget that is from 1 to 5. Here we have 10.5. Of course, I will have to list the other components of equity, pre-acquisition, other components of equity of the subsidiary, because we don't need them in our group financial statements. So minus this. Then we also have the exchange and fair value movements. On the foreign assets, on the foreign functional, on the foreign financial asset, of course. That is from working number 6. This was 2.0. It was for NUL. This was 2.18. So this gives us 14.68. This is 0.5M. Of course, the group has a share in the 0.5 as well as the 14.68. So we come here, we say group share. In ML, the group has 60%. 60% times 0.5, that is 7.5. Then still the group has a share in NUL. That was 36%. Check your group structure. Times 14.68M. This is 8.2. Of course, we add this, and this. Then we get the total for the group. Get the total for the group, which is 88.7. So other components of equity in the statement of financial position, you take 88 point, you take 88.7. Then, of course, from there, we shall have to come up with a working for retained what? We shall have to come up with a working for retained earnings, consolidated retained earnings, which is to appear in our statement of financial position for the group as well, which is to appear in our consolidated statement of financial position. So my working 8 is about the retained earnings, group retained earnings. Group retained earnings. Still, I will have to show DL, the parent, ML, excuse me, ML, as well as NUL. as well as NUL. So we have per the question, of course, you copy what you have in the question, per the question. For VL there is 620, ML there is 465, then NUL it is 175. Of course, we have an impairment reversal. Don't forget the impairment reversal. Don't forget the impairment reversal. I think this was from working 5. This is from working 5. And your impairment reversal was 5.8 GL. That property was for a parent. Then, of course, we have depreciation expense. Depreciation expense. This is the expense from the alteration costs. On the alterations, okay, you can say the depreciation expense from the alterations on the listed building. That was 1.4, it's an expense. Don't forget the finance cost on the provision from that very working. That was 0.198. We have the incorrect expense. Incorrect expense of the building costs. Incorrect expense on the building what? On the building cost. That is what now for steel. That was 6.6. A credit, so you add the back. We add the back that. Then what else? Then we also have reversals. There is something I'm going to talk about here. Reversals of investment gains. Reversal of investment gains on NUL. At the time when the parent company obtained control, NUL had a valuation of 155 M. The fair value, the fair value of the 14% interest. Because they are telling us here in the question that the fair value of the 14% holding of DL, which was classified as fair value through profit or loss, was shillings 140 million and shillings 135 million 30th June 2018 and 30th June 2019. There is a gain on this investment. That gain has to be eliminated. Yes, the parent recognizes that in its individual financial statements, but when it comes to book financial statements, we have to eliminate this gain of the difference between these two values, 155 millions and 140 millions. That's around 15 millions. That one has to be eliminated. That one has to be eliminated. Place the pre, don't forget. We don't need the pre-acquisition earnings of the subsidiaries. We don't need these. You can get this from working through that of goodwill. For ML, I see we have 325, so you minus that. Then for NUL, you minus 120. So this is 55. This is 140. That is 1. That is 140. Of course, those are the post-acquisition earnings. You can come and say group share. In ML, the group has a shareholding of 60%. So that will be 60% of 140, which gives us 84. Then in NUL, we have a shareholding of 56% times the 55, giving you 30.8. Then we have an impairment loss on the goodwill of ML. NCI is measured at a proportionate share, so the group takes all that share in the impairment loss. Less impairment loss on goodwill of ML, and check working two. That impairment loss on goodwill was 18.4. In fact, the entire goodwill figure was fully impaired. So when you do the additions and subtractions, you'll come up with group retained earnings of 712.2 million. That will be your group retained. That will be your group retained earnings. Now this note is about the gains. The gain. The gain in the Aries books. On the Aries investment in NUL, since NUL has been a subsidiary, since NUL has been a subsidiary, must be reversed. Must be reversed on consolidation. Must be reversed on consolidation. And of course, according to the first note, the examiner stated that those gains have been recognized or are to be recognized in the statement of profit or loss. That the fair value of the 14% holding of 14% in DL of DL, which was classified as fair value of profit or loss, was that and that. So that's why I'm reducing my group retained earnings by sharing how much? By sharing 15 millions. So that is our computation of the retained one. That is our computation of the retained earnings for the group. The other computation is going to be about the NCI. at their end. Non-controlling interest. So that will be working number 9, non-controlling interest. Non-controlling interest. When it comes to non-controlling interest, we have the NCI in ML as well as the NCI in NUL. This is shillings millions, shillings millions. So you start with your NCI at APWI. At acquisition, we computed this in working two. The NCI at acquisition in ML, this was 40.4. Then for NUL, this was 261.8. Then we get the share. NCI share of post acquisition retained earnings. Of course, you have to refer to the previous working. So ML, it's a 40% times 140 M. This is from working 8. This gives us a 56. Then for NUL, it is 44%. Times 55. This is working 8. So this gives you 24.2. Remember, the NCI also have a share in the other components of equity. NCI share of post-acquisition other components of equity. So in ML, their share is 40% times the 12.5 M. This was from working number what? Number 7, other components of equity. This gives us 5. Then NUL, 44 times what? Times 14.68 M. So that is from working 7. This gives us 6.5. Then maybe the other adjustment which you have to make is to less the NCI share of investments in NUL. The NCI in ML, they have a share of 40% in the cost that ML paid to acquire shares in NUL. That was 635 million. That share of investment is eliminated. We have to deduct it from the NCI of ML, and this is 254. When you do the additions, this gives you 292.5, and then this gives us 211.4. when you add your NCI is 503.9. So that's the NCI figure I'll take in the statement of financial position of the group. Then the other thing we can also note, this can be our working number 10. We can call this fair the fair value adjustment working. When it comes to this working, you have to show the value acquisition date. You have to show the movements and then the value at the reporting date. So we have two fair value adjustments. We have one in ML, and this was non-depreciable land. Non-depreciable. This was non-depreciable land. And when you try to check your working for goodwill, you see that the fair value of this non-depreciable piece of land in ML, this was working too. This was at 17.5 at the date of acquisition. Land does not depreciate. The movement is all about depreciation or amortization, but land does not depreciate. Then at the reporting date, we still carry our land at 17.5. Then lastly is the fair value adjustment for NUL. Still, it is also a non-depreciable land. Still working too. And the fair value adjustment, the excess here was 20. Land does not depreciate, so the movement is still nil. So that's what we have. Those are the workings we have for this question of March 2022. Let us see how you can come up with our balance sheet for the group. Let us see how you can come up with a consolidated statement of financial position. So let us come up with the consolidated statement of financial position, in this case for the GL group. So you write GL consolidated statement of financial position as at June 2019, as at 30th June 2019. So this is our heading. So we have shillings millions, where we have non-current assets. Under non-current assets, of course, we have the PPE. But our PPE, you get that of the parent, which is 720, plus ML, we have 550. Then you add NUL of 650, then plus the fair value adjustments of 17.5. That is from working 10. Then you add the 20 fair value adjustments still from working 10. Then plus 9.9 leased manufacturing unit that was working 4. Then you have to add the fair value 16.3. If this was on working 5, the property that was revalued. Then you have to minus the depreciation on the alterations, that is working 4. So this gives me 198, 2.3 million inside. Then you get your goodwill from working 2. That goodwill is 187.8. That is goodwill for NUL. Then we have financial assets, 160 for the parent, 10.5. Then you have 70.5. Then you have the fair value movements and exchange differences from working 6. This gives us 243.2. When I add this, I get a total non-current assets figure of 241.3. Current assets, parent 160. The current assets for the parent, we have 160. We have 160 for the parent. 160 for the parent. Then for the subsidiary, we have 10.5 ML. Then for NUL, we have 70.5. No. Here I'm using financial assets still. Supposed to look at the current assets, not the financial assets. Your current assets figure for the parent is 627.5, then plus 376.5 ml, then NUL is 95. This gives me a total of 1099. I told you don't adjust your inventory for the loss. Being that it's a loss, it is realized and the sale was made at fair value. This gives you a total assets of 3512.3. That is our total assets figure. That's our total assets figure. That's our total assets figure. Then we move to equity. We move to equity attributable. Equity attribute to the owners of the parent, and under equity attribute to the owners of the parent, here we have to show the share capital. Here we show the share capital, which is 875 for the parent, remember. 875. Then we have the share premium. Share premium, that is 180 for the parent still. Then retained earnings, don't forget them. Retained earnings, this is from working number what? Number 8, we have our 712.2. Then other components of what? Other components of equity. This was from working number 8. Is it really? No, this is from working number 7, I think. Other components of equity. We have this from working number 7. And this is 80. This is 88.7. When you add, you get total equity attribute to the owners of the parent of 18.5.9, I think, 7.2. Then you bring your NCI. This is from working 9. NCI, our working 9 shows 503.9. Then we get total equity. Total equity of 2359.8. That is your total equity. Then from total equity, of course, you move to the non-current liabilities. We continue on the next page. Non-current liabilities. Continue the next page. Non-current liabilities, according to the question here, of course, they told that you have long-term debts. Long-term debt. So you add the parent for 64.5. You add ML, which is 342.5. Then subsidiary NUL sub 65. This gives you 872. Then you have the provisions of greater than 1 year. Here you have the parent with a 28, sub with a 40, NUL with a 10. Then we have the 3.3, the provision for restoration costs working for. That is a long term. So that is 81.3 when you add. Then you move to the current liabilities, where you have trades and other payables. This is 32.5 plus 35.5, then plus 28, no any adjustments. That gives you 96. Then finally we have provisions of less than 1 year. The parent has 25, ML has 8, NUL has 70, but I'll add 0.198, the finance cost on the provision. That is working for, and this gives us 103.2. 3.2. We get 96 plus 103.2. This gives us 199.2. That is total current liabilities. Then non-current, 1.3. Non-current is 953.3. So when you add all that, what do we get? We get total equity . Total equity and liabilities. Total equity and liabilities. Total equity and liabilities. Your total equity was 2359.8. When you add, you get 3,512.3 as your total equity and liabilities. So that is March 2022. 2022. The other theoretical parts, we shall cover them in our next revision session. We are going to stop here for today. In case you have a question, please, you can share your question in the comments section below, or you can check me on my other social media platforms and you send your questions. I will answer them. Thank you for participating. I wish you a good evening. Bye bye.